As the market remains closed for the weekend, Opendoor Technologies Inc., trading under the ticker OPEN, last finalized its trading day on Friday, September 12, 2025, at a price of $9.07. This represented a significant and painful intraday drop of 13.78%. A figure like that naturally sends a wave of concern through the retail investment community, triggering fears of a sustained downturn. But the expectation that this is just another volatile tech stock succumbing to market pressures would be a dramatic misreading of the situation. The reality is far more complex and circles around a monumental executive shakeup that has completely redefined the narrative for this company in the span of a single week. What we witnessed was not a simple price collapse. It was a violent and immediate reaction to a seismic shift in leadership and strategy, a moment that has forced every investor, from those using sophisticated platforms like interactive brokers to those just starting with a SoFi Invest account, to fundamentally reassess their thesis on the future of the iBuying real estate market. The common belief, the story that has been circulating for months, was that Opendoor was a company struggling to find its footing in a difficult housing market. High interest rates were supposed to be the insurmountable obstacle, constricting the very lifeblood of its business model, which relies on the rapid purchase and sale of homes. The market had seemingly priced in this struggle, with the stock languishing for an extended period. This was the expectation, a slow, arduous grind against macroeconomic headwinds. The reality, however, crashed onto the scene with the force of a wrecking ball last week. The announcement that Shopify's Chief Operating Officer 𝐃𝐍𝐂𝐋 would take over as the new CEO, and that co-founders 𝐃𝐈𝐒𝐂𝐋 and Eric Wu were rejoining the board, completely shattered the prevailing narrative. This wasn't just a leadership change. It was a declaration of a renewed, aggressive vision backed by a $40 million investment from Rebois's venture capital firm and Wu. The stock's subsequent and explosive surge, closing up 78% on a single day before Friday's sharp pullback, signals a market in the throes of a violent repricing, torn between the old fears and a new aggressive hope. Friday's 13.78% decline, therefore, is not a continuation of the old trend, but a direct consequence of the new one. The initial euphoria gave way to profit-taking and a more sober assessment of the monumental task ahead. The trading volume on Friday was immense, clocking in at over 472 million shares, dwarfing its daily averages and indicating that institutional players and retail traders alike are actively repositioning. This is not the slow bleed of a dying company. It is the chaotic churn of a high-stakes recalibration. We're seeing large blocks of shares moving, suggesting that established funds, perhaps those managed through services like Fidelity Wealth Management or Schwab Intelligent Portfolios, are making significant decisions. The introduction of a figure like 𝐃𝐈𝐒𝐿, a well-known and outspoken venture capitalist, brings a founder DNA back into the boardroom, a factor that the market is still struggling to properly value. His immediate and public statements about the company being bloated and needing to potentially cut a significant portion of its workforce have introduced a new layer of expectation and reality. The expectation is that this new leadership will bring fiscal discipline and a renewed focus on profitability. The reality is that such restructuring is often painful and fraught with execution risk, which partly explains the sharp reversal we saw to end the week. To understand the magnitude of this shift, one must understand Opendoor's business. The company pioneered the iBuying model, which aims to simplify the incredibly complex and often stressful process of selling a home. Using algorithms and vast amounts of data, Opendoor provides homeowners with a near-instant cash offer for their property, eliminating the need for listings, showings, and months of uncertainty. The company then makes minor repairs and aims to resell the home on the open market for a profit, generating revenue from the service fee it charges sellers and the spread it makes on the sale. This model is inherently capital-intensive and highly sensitive to fluctuations in the housing market. When home prices are rising steadily, the model works beautifully. But when the market cools or interest rates rise, as they have over the past couple of years, the carrying costs of holding a large inventory of homes can quickly erode margins and lead to significant losses. This sensitivity is what led to the previous pessimistic outlook and the widespread belief that the company was on a perilous path. Many investors using online investing platforms like Robinhood or Fidelity had likely categorized this as a high-risk speculative play. The recent executive overhaul is a direct challenge to that narrative. The appointment of a seasoned operator from a tech giant like Shopify suggests a focus on operational excellence, efficiency, and leveraging technology to a much greater degree. The return of the founders signals a return to an aggressive, growth-oriented mindset. The market is now grappling with a new set of questions. Can this new team navigate the challenging housing market more effectively than the previous leadership? Will their focus on cost-cutting and efficiency lead to a sustainable path to profitability, something that has eluded the company for most of its existence? Analyst ratings are currently mixed, with a consensus hold rating reflecting this deep uncertainty. Some see the potential for a massive turnaround, while others remain skeptical about the fundamental challenges of the iBuying model in a high-interest rate environment. This tension between the bullish expectation of a founder-led revival and the bearish reality of the macroeconomic landscape is what is fueling the current volatility in the Tesla stock, Apple stock, and now very clearly in Opendoor stock. Looking ahead, the future of Opendoor hinges on several key factors. The most immediate is the direction of the U.S. housing market and Federal Reserve interest rate policy. Projections for 2025 suggest a market that will remain somewhat subdued with only modest growth. This means Opendoor cannot rely on a rising tide of home price appreciation to lift its fortunes. Instead, it must execute flawlessly on its internal strategy, refining its pricing algorithms to buy homes at the right price, minimizing renovation and holding costs, and optimizing its resale process. The company's ability to manage its inventory and maintain healthy margins will be under intense scrutiny. Any sign of miscalculation in its home acquisitions could be severely punished by the market. Furthermore, the competitive landscape in the proptech industry is evolving. While Opendoor is a major player, it faces competition from traditional real estate brokerages and other technology-driven platforms. Innovation in areas like e-signing, virtual tours, and fractional real estate investment is accelerating, and Opendoor will need to remain at the forefront of this technological wave. The path forward is not for the faint of heart, and investors considering an entry point must weigh the enormous potential upside against the very real risks. This is a story about more than just online investing. It's about the disruption of one of the largest asset classes in the world. Comment below with your thoughts on the housing market. Do you see interest rates coming down significantly by the end of 2025? In summary, the dramatic price action in Opendoor Technologies Inc. stock is a textbook example of the market's struggle to reconcile a powerful new expectation with a challenging underlying reality. The closing price of $9.07 on Friday, a steep drop after a meteoric rise, encapsulates this conflict perfectly. The expectation, fueled by a high-profile leadership change and the return of its visionary founders, is a radical transformation and a return to aggressive growth. The reality is a difficult housing market and a business model with inherent vulnerabilities that this new team must now navigate. The coming months will be critical in determining which of these forces will prevail. The intense trading volume suggests that big money is making its bets, and for the individual investor, this remains a volatile and high-stakes narrative. The story of Opendoor has been completely rewritten in a matter of days, and the market is now waiting to see if this new chapter will be one of a legendary turnaround or a cautionary tale.